Hello, everybody, and welcome to UFile's first podcast for tax season 2022. My name is Ida Celli. I'm your host for today, as well as with my friend, Gerry Vitoratis. Actually, we're co hosting this podcast. So, hi, Gerry. How are you?
Pretty good, Ida. How's it going?
Pretty good. Are you really ready for the next tax season?
Not really, but what choice do we have at this point? I
Exactly.
mean, we're never really fully ready, right? I mean, it's just tax season just hits you like a ton of bricks, and unfortunately, we just gotta keep at it. We just gotta keep going. That's the business we're in. We're there to teach people, to produce the software, right? That everybody knows and loves, and we're there also to teach people about topics within taxation. That's what this podcast is about. So, what are we talking about today?
Today, we're going to talk about the new changes that will be affecting the 2022 taxes, as well as whatever was important on the budget that came out in 2022 towards the end of 2022.
Yeah,
So,
I
and
mean.
actually, the first point relates to
mm,
the budget, the tax-free first home savings account.
Yeah, so I mean, there's some items that we're going to talk about, right as you just mentioned.
Yes.
Now, the first one is actually 2023 in this case, not even 2022. It'll affect 2023, which is the current year that we're in right now, and that is, as you mentioned, the tax-free first home savings account. So, what is it? What's the FHSA? Is the acronym that the government uses for this account? Very simply put, it is a new tax-sheltered registered account in which you can contribute on a tax-free basis. Essentially, anything that stays, any gains you make within this account will be tax-free and tax-sheltered. And the purpose of the account is to help you save money for the purpose of a down payment of the purchase of what the government considers as a first home. And I say that, under quotation because it's a very specific definition of what the government considers as a first home, meaning that the government considers that you are purchasing your first home when either in the year or in the 3 prior years, you did not reside in a home in which you owned. Okay, that's the key. All right. As long as you meet that criteria, you are allowed now to create this new tax sheltered account called the FHSA. Now, the government kind of borrowed some characteristics of the two existing tax sheltered accounts that we know of, which is the RSP that we know, of course, that are common,
Yeah.
and the TFSA. Right, those are the two, and it kind of borrows characteristics of each one. So, for example, any contribution I make to this FHSA is tax deductible, so I could deduct it on my tax return. Okay, and then on the other side of the equation, when I withdraw from the FHSA account, as long as I withdraw for the purpose of a down payment in the purchasing of my first home, then the withdrawals are tax free, like a TFSA account in this case. So it kind of borrows from both. Okay, now the key here is that when you create the account, you must be considered a first time home buyer, meaning that essentially neither you nor your spouse, and that's the key here, nor your spouse, okay, were homeowners of a property in which you lived in, okay, either in the current year or in the 3 previous years. Okay, that's the key there. And of course, you have to be over 18 and you also have to be a resident of Canada, okay, in order to be able to contribute those accounts. Now, once you meet those three basic criteria, you are now allowed to contribute, okay? And the moment you find your first home and you're ready to put a down payment, you withdraw from the FHSA, and the withdrawal is entirely tax-free as long as you keep meeting that criteria. In other words, the year that you withdraw, you are a first-time home buyer under the criteria that I mentioned before. Now, the key, remember what I said, is neither you nor your spouse. That's an important nuance, which means that if only one of you is eligible, then neither of you are eligible, okay, for this account and for the withdrawal, because again, it's either you or your spouse, the rule. So we have to make sure of that. Now, the other characteristics of the account is that you can make transfers from the account, from this FHSA, to an existing RSP account or a new RSP account that you want to create. And the advantage of that is that you could transfer these amounts tax free. Number one, there's not taxable these transfers, and number two, they never affect your RSP deduction limit. So you can already see some tax planning ideas that you can do here, especially for those of you who are maximizing your RSP contributions every year and you are considered a first-time home buyer, meaning that you're not living in a home that you owned either this year or in the 3 prior years. Okay, that's the key. Now, you could also perform transfers the other way around. For example, if you have a FHSA and you want to transfer to an RSP account, you can do so as well. But when you make that transfer, now you're using up the limits that are set by the CRA and by the federal government for your FHSA account. So, what are those limits? How much are you allowed to contribute to this account? It is an $8,000 annual limit, and this is set by the government, meaning it's not based on any income you gained or anything else. It is $8,000 that is set by the government annually and $40,000 lifetime limit. Okay, that's what the government allows in this case as far as the FHSA. Okay, now, like I said, you could transfer either case. Now, if you transfer from an RSP to an FHSA, okay, now in that case, you are using up your limit. The transfer is still tax free, but you are using up your FHSA limit. But again, tax planning wise, that could be interesting because if you've got a lot more funds in your RSP than your FHSA, if you're now deciding that you're about to go and get a home, you could perform that transfer and now you can withdraw from that account tax free when you're ready to buy a home. Okay, and that's where that's where it comes in. That's where the advantage is. Now, are you required to put in 8,000 every year? No. You could put less than that, and any amount that you any amount that you did not contribute, you can carry forward to the following year. Okay, so for example, you put in 5 instead of 8,000, you've got an extra 3 you can contribute in the following year. Okay, you're allowed just like an RSP
Hmm.
account in this case. Now, it is not eternal, this account. Okay, you can't have it forever like an RSP that converts into a RIF. Okay, so if you withdraw from the account, it is a once in a lifetime account, meaning that the moment you withdraw to buy your home, it's closed and it's done. Okay, or if you haven't purchased a home within 15 years of when you create the account. So if that happens, then you transfer simply the funds to an RSP account. Okay, that's what would happen there, and you would transfer them tax free. So again, a great account, a lot of tax planning ideas that you can do. For example, for those of you who maximize your RSP contributions and you have some extra funds you want to shelter, an FHSA becomes interesting, even if you're not thinking about purchasing a home in the near future. Okay, because remember that you could always transfer those accounts to an RSP later on.
All right. That was long.
There's quite a bit. There's
There's
quite a
quite a
bit
bit on
there.
that one.
Now,
Yes.
the great news is we wrote a nice detailed article about this on our UFile blog. You simply go to ufile.ca, go to the tips and tricks tab, and then you're going to see in there UFile blog option. So once you click on that, we have a really detailed FHSA blog on this, which we just corrected because the government made a lot of changes to, and they made a lot of changes recently to this account. We also did a video on this on our YouTube page, which unfortunately has to be updated as well due to the changes that the CRA has made. Watch for that coming soon. I will be recording a new one for that. Basically, long story short, the update the government has made is a lot of people had a lot of questions thinking that, well, there's already the home buyers plan that exists, right? That you could withdraw from your home buyers plan in order to purchase your first home from your RSP account. Can you use both? Originally, the government had said no. You had to choose between an FHSA account or a home buyers plan withdrawal. You had to choose between the two. Now the government amended this and you can pull out from both. Okay, because the government has removed what they call the exclusionary clause. Okay, between these two accounts, so you can actually use both to purchase the first home.
Very interesting. And to follow up as
Yeah,
as
absolutely,
they make it more
absolutely.
clear.
If the government doesn't change it again.
Exactly. Now, the next topic is labor mobility deduction for tradespeople.
Yes, yes. So that one is a new deduction on the tax return. Kind of, similar concept when it comes to an RSP, meaning you're reducing the taxable income you're being taxed on. Okay, that's what the deduction is in this case. So the labor mobility deduction, in what's called in summary is for any tradesperson or what is considered a tradesperson that is required to travel in order to work at a work site, and then of course incurred travel expenses out of their pocket in order to work at this work site, so their employers did not reimburse them their travel expenses in order to work at this work site, then what this deduction allows is to deduct these travel fees or travel expenses that the employee incurred to travel to that work site. Okay, now the government caps the amount that you can deduct at $4,000 for all the traveling that had to be done for all the work sites combined. Okay, so what can you claim as an expense if you're a tradesperson working in the construction industry? And that's the key there, is that it can't just be any tradesperson. It has to be a tradesperson who works in the construction sector. Okay, so any one of those tradespeople that was required to travel to a work site and paid these travel expenses out of pocket, the expenses you can deduct are your transportation costs, meaning fuel or bus ticket or plane ticket or whatever it is. The second one is any meals that you incurred along the trip, and then the third one is any hotel fees that you paid in order to stay there overnight to the work site, which we're going to see is actually a requirement, okay, to be able to claim that deduction. All right, now when they get to that work site, these employees will need to track now the employment income they've gained at the work site. The reason for this is because the government, I mentioned before, the overall deduction you're allowed is $4,000 for all the work sites combined, okay, that they were required to travel for the year. Okay, now per work site, though, the government implements an additional limit, and the limit is 50% of the employment income that was gained at that work site. Okay, so now these employees have to track, okay, what their employment income was at the work site in order to determine what they're allowed to claim as a deduction for those travel expenses that they incurred, okay, per work site in this case. All right, now anytime the government gives you any deduction for any travel expenses, they usually put a minimum kilometer requirement, whether it's moving expenses, whether it's medical expenses that are not within your region, there's always a minimum. And the minimum for the labor mobility deduction is 150 kilometers. So if you were required to travel at least 150 kilometers to the work site, then you can deduct your travel expenses. The other criteria is that you have to also stay there overnight, meaning that the government requires a 36-hour stay period at the work site. So in other words, overnight. You have to at least stay there for one night in this case. Okay, so that's the key. That's the key for the deduction.
Okay. There has been some rate changes for the home buyer's amount as well as the home accessibility.
Yeah,
You want to elaborate a little bit?
sure. So, I mean, speaking of first-time home buyers, right? So, continuing with that theme, not only can you, for example, withdraw under the home buyers plan if you're a first-time home buyer, or withdraw from an FHSA account because you're a first-time home buyer, you also get a credit on your tax return, a non-refundable tax credit in this case, which is the home buyer's amount, which ordinarily is $5,000 at a 15% clip, as long as when you purchased your home, you're a first-time home buyer in the year. Okay, and remember what the rule is, right? In the year and the 3 previous years, you did not own the property that you lived in. Okay, that's the key. All right. So ordinarily it was $5,000 credit. Now the government has doubled that credit to 10,000. So that means that before I would claim 5,000 at 15%, which is $750 as a credit to reduce my tax owing. Now I can claim up to $1,500 because it is 10,000 at 15%. Okay, so $1,500 as a credit. Okay, so that's number one. The other rate change that they brought about is the home accessibility tax credit. And this one is a non-refundable tax credit in which you can claim renovation expenses to make a home more amenable, okay, to two specific types of individuals. Either it is somebody who is 18 and over and is disabled, or is certified as disabled by a doctor and confirmed by the government, in this case by the CRA, or it is somebody who is 65 years and above, regardless of if they're disabled or not. So as long as the renovation expenses relate to making the house more amenable, meaning, for example, rails in the bathroom, rails in the shower, what's called like a ramp to get inside the house for a wheelchair, for example, et cetera, et cetera. These are the kind of expenses. Those expenses previously were capped at $10,000 for that non-refundable tax credit. Okay, so it was a credit, which means you claim it at 15%. The government, again, is doubling okay, that credit to the limit of the expenses in this case to $20,000 instead of 10,000. Okay, so that's quite a substantive change. It's quite a substantive increase for that credit.
It's good. Now, the government came about with the Canada's affordability plan. I know that encompasses several things.
Yeah.
So, do you want to go over the main points?
Yes. So the Canada Affordability Plan was three components essentially. Okay. So in order to help individuals with, for example, certain expenses and very specifically for inflation that has gone quite high, right? In the last towards the end of 2022 and now in 2023, we have noticed that inflation is really high. So the government made this announcement in order to help Canadians who are struggling with this inflation. So the first component of this was a doubling of the GST credit, which is a quarterly benefit that eligible individuals claim by simply filing their tax return. So as long as these individuals are below a certain income threshold, which is around, for somebody who's single, it's got to be around the 30 to 35,000 range, something along those lines. They claim essentially a quarterly benefit that is tax-free directly from the government. Okay, so what the government has done is for the last two payments of 2022, they doubled that amount for those individuals who were eligible for the credit. So if you were entitled, for example, to $95, they're doubling that amount that you're collecting. That's the first one. The second one was the Canada Dental Benefit, and this is a new benefit which is a tax-free payment that the government makes, okay, directly to individuals who have children that are less than 12 and in which they incur dental fees for those children, and the parents are not covered, whether it is under a private insurance plan or whether it is under a provincial medical plan. So for example, some provinces cover the dental fees of children that are less than 12. For example, where we are from right now in Quebec, we're covered under the public insurance. Now, there are some provinces though that are not covered in this case, and the parents have to pay for these expenses out of pocket. Okay, so in this case, you could get the grant, or in this case, the benefit, as long as your combined income, your combined net income, you and, if applicable, your spouse, is 90,000 and below. Okay, so we have a very detailed article about this again in our blogs, okay, in our UFAL blog. Simply go in there and look it up again in the UFAL blog. You'll see all the details because there's different ranges of amounts you can collect from $260 on the upper end all the way down all the way up to like $600 $700 if your income is lower. Okay, so it's progressively reduced as your income goes up until a cap of 90,000 where you lose that benefit. Okay, and this is a tax repayment that is given to parents directly, but of course you have to show proof to the government through the My Account portal. You have to first of all apply for this benefit, and second of all, once you apply, you must show proof to the CRA in this case that you have actually paid fees for your child that is less than 12 years old. Now, the last one is the Canada Housing Benefit of the Affordability Plan. This is a $500 one-time payment, which is tax-free, to individuals who pay rent and who are very low income in this case. So for example, if it's a family or a couple, the threshold is 35,000 and below, while for somebody who is single, it is $20,000 and below. So it's really targeted towards people that don't have a lot of income in the year. And also you must show proof to the CRA that at least 30% of your net income is dedicated towards paying your rent. Okay, and you do this through what the government calls an attestation-based application. Again, it is through the My Account portal of the CRA site. We vaunt this portal quite often in these videos. It's a great portal that the federal government offers. I strongly urge everybody to sign up to it. All of your tax picture, all of your tax history is in this portal. The government makes it great and easy to use. You can amend your returns as well. Again, I'm being a salesperson now for the CRA, but it's a great program. And I strongly urge all of you who are listening to this, who are watching this, to apply for it. Because as you can see now, the government is requiring you now to go to this portal to apply for these benefits. Okay, so you might as well, even if you're not eligible for these benefits, we don't know what the future holds. Maybe there'll be other benefits that you will be entitled to. Might as well be ready for them and sign up for that account. So those are the three programs of the Canada Affordability Plan.
And they could read up on it on our blog to get more details anyways. So
Absolutely. Again, ufile.ca, go to the tips and tricks, go there, and there's an option there called ufile blog. Click on that. All the details are there with all the references. Absolutely.
correct. Now for businesses, there's the immediate expensing of depreciable properties.
Yeah, that's the big one. That's the big one this year, especially for businesses, right? And not just actually businesses that are unincorporated. It's also for incorporated businesses as well, for corporations. Okay, so
Hmm.
this measure is applicable to both. Very simply put, because it's quite complex as far as all the rules and how it works and etc. But very simply put, as is summarized, we just we're putting up the tax update article very soon now on our website, and we post a link to our professional blog from our professional site at thomsonreuters.ca, where we give all the details on immediate expensing. We provide the link in the UFile blog. Okay, now, very simply put, what immediate expensing allows you to do is that if you're a business owner and you need to buy equipment or other depreciable properties that ordinarily you can't expense at 100%. For example, you buy a desk, right, for your company, right, for your office. Okay, that desk ordinarily you could only capitalize it, meaning you can't claim it as an expense in the year. You must claim it under depreciation expense, which means a percentage of the value of that property every single year. What immediate expensing allows you to do is to expense at 100% in the year you purchase and you put to use this equipment. So I buy my desk for my business in the year. Okay, that means that whatever that value of desk is, let's say I paid, I don't know, $500 for my desk, I can actually claim $500 as a depreciation expense. That's why it's called immediate expensing. You're expensing it fully in the year. When ordinarily I'd only be allowed 20% of the value of that desk, and in the first year I would only be allowed 10 ordinarily. So it just goes to show you how limited it is. Now I could claim the full 100% expense. Now, there is a limit to this, and not every kind of property is eligible. For example, real estate properties are not eligible for this. Okay, so if you buy a building, for example, for your business, not eligible, or for a rental, for example, that's not eligible. Okay, but in this case, there is a limit to the total amount of depreciation expense you can claim for all these properties combined, and that's 1.5 million. Let's not kid ourselves. For most individual businesses, they won't come anywhere near that limit. However, if you are a business owner, but also you have shares or you control an incorporated business as well, that 1.5 million limit has to be shared between the two entities. Okay, meaning that what's called I can't claim fully 1.5 million for my individual business and 1.5 million for the corporation. I can't double up the limit. If I control a corporation, and if of course I control my personal business in this case, in that case I have to share that 1.5 million between the two. Now again, all the details are found in the UFile blog. Simply go in there and we link to our professional blog, okay, that we have for our professional product on thomsonreuters.ca, and we give all the details there as to how it works. And soon we're going to post an article on the mechanics of it, how we actually compute the amount.
Great. And I know you're writing that one too, so
Yes, absolutely. Absolutely.
you're well versed. Okay, the next one is the Canada Workers Benefit.
Yes, so that's an administrative change. So last year there was changes to that credit where the government essentially increased that credit last year. So in other words, the eligibility thresholds for the credit were increased last year substantially by $10,000. So as before, if you made about 30,000, you were single, you couldn't claim that credit.
Hmm.
Now you can since last year. Okay, so the Canada Workers Benefit, very simply put, is a refundable credit. Okay, that is targeted towards workers that have lower income, meaning workers that are around, for example, if it's a single individual, it's about 32,000. For a couple, it's around 42,000. As long as they're below those thresholds, they get an additional credit. And what's great about it being a refundable credit is even if you're not taxable, you still collect the credit. Okay, it's not like non-refundable credits where they just reduce your tax owing to zero and then you can't claim the excess. Here, if your credit is more than your tax, you're claiming the excess as a refund. That's the beauty about refundable credits. Now, what the government is doing starting in July 2023 is that they'll start paying half of this credit, which ordinarily you're claiming on the tax return, as a quarterly benefit is what they're going to do starting in July. So every 3 months after July, you're going to be collecting you're going to be collecting half of that credit directly in your bank account instead of waiting to file your tax return the following year to collect the credit. So that's great news there because you're getting it in advance. And as long as you're eligible for the credit for the last tax return that you filed with the CRA, then you will start collecting that benefit starting in July directly, but only half. The other half you'll collect when you file your tax return.
Fair enough.
Yeah.
Now, the other topic really concerns the Ontario people,
Yes.
and this is the staycation tax credit.
Yes, it's a great term, by the way. I really love. I mean, the
I like the
marketers
term. I like the
I mean, the
term.
marketers in the Ontario government did an absolutely amazing job, calling it staycation, which is true. Conceptually, what a staycation credit is that and this is of course only targeted to Ontario residents. Okay, so for those of you who are listening to us, you're not in Ontario. Well, sorry guys, there's no staycation credit for the rest of you. We're in Quebec and we didn't get one either, right? So unfortunately, the Quebec government didn't follow in this case. It would be great if they would. But essentially, long story short, it's a new refundable credit, which, if memory serves me, is about 15% that you can claim for any accommodation fees or, for example, hotel fees that you pay as long as you took a vacation in Ontario within the province. So the government is trying to stimulate the tourism sector, which, as we know, with the pandemic, got absolutely hit. I mean, they were just absolutely, they were really hit gravely during the pandemic. So what this does is that if you're an Ontario resident, you took a vacation, you went somewhere in Ontario, and you stayed somewhere, be it hotel, motel, a lodge, a cottage, a vacation rental property, etc., you can claim the fees that you paid for those accommodations for the staycation credit, which is, like I said, a refundable credit again. Remember, that means that if you have no tax owing, you're still collecting the credit. They're going to give it to you as a refund. Okay, and if memory serves me, it's 15% of that amount. Now, if you're single, you can claim up to $1,000 of accommodation expenses. If you are in a couple, if you have a spouse, you can claim up to $2,000 of that credit. So that is, it's a great initiative by the Ontario government to try to stimulate tourism sector, and that's what they did with this credit.
Mm, that's pretty good. Well, it's good for the Ontario. It boosts a little bit their own tourism and helps the restaurants and as well as the hotels in the area.
Yeah.
So I think that pretty much covers our podcast for today.
Mhm.
So any last words of wisdom before we sign off for this podcast?
Yeah, sure. So, I mean, just remember that whatever we spoke about today and then some, because we actually had to keep, I mean, we're already at 27 minutes here, in this session. And imagine we actually cut things from this video. Imagine we actually have some additional amounts that are on the tax return that we speak about within our UFile blog. Okay, so we're about to post right now a tax update session. If it's not already posted,
Next
tax
week.
update blog, which is next week. We're going to post all of this there. So all the details of what you need for anything that we spoke about in this podcast will be on our website, which is ufile.ca. Go to tips and tricks again and choose UFile blog. Okay. And at that point, it'll be the first article right up there with a tax update. So go up there and, get the information that you need, including some additional changes that we didn't even speak about because I mean, how long can we make this video, right? Or this podcast,
Uh,
right? We're already at practically half an hour. So we had to cut in this case. So there's a bunch of other ones that are in there as well. So our website has a bunch of information that will help you, that gives you additional information on your tax return to be more effective with your tax return. Okay, some tips and tricks on saving you money as well. All right. Now we also have our YouTube page, which some of you are watching from directly. For those of you who are listening to us, you could also watch the podcast on YouTube directly. Okay, just look up UFile and look at our official page, and we post videos of how-to videos on the software. We also post some educational videos on various topics, like FHSA was one of them that we posted, which unfortunately I have to update now. So there's a bunch of videos that are there to help you, to guide you with your tax return. And don't forget our Facebook Live sessions, which we do. Now we're going to start ramping them up every 2 weeks. Simply go to like our Facebook page, and you can participate in these live Q&A sessions. You could ask me any question you like on the tax return, and I'm there to answer your questions. So do not hesitate to go on our Facebook page, like our page, and activate the notifications so you know when the next Facebook Live session, so you can participate in it.
All right. So if you guys go to ufile.ca, you will see the icons at the bottom of the page for our YouTube, our Facebook, so you can have easy access from there. Gerry, thank you very much for taking the time
Thank
and
you.
answering these questions. Uh, Thank you everybody for listening to ufile.ca podcast. Ufile your taxes your way. Thank you very much and speak to you next time.